15 Rules of Money. When it comes to personal finance, the key word is personal. There are no one-size-fits-all rules for running your budget, savings, retirement planning, or other aspects of your financial life. Some general, tried and tested rules can prove useful for planning your financial life, while you might decide to tweak these rules in application. They can be helpful for guiding your financial decision-making. So if you want to master the game of money, here are 15 financial rules of money that will help you rock your budget and retirement savings, future financial planning, and more. Is going to teach you everything you need to know about money. 1. Attract money with mind. Attracting wealth into your life requires that you go beyond wishful thinking. First of all, attracting money starts in your head. You must have a positive attitude and a good money mindset. Furthermore, you need to make an honest assessment of your current money state and develop a vision of what attracting money into your life means for your future. Your money mindset is how you think about money. You want to focus the positive attitude towards money. It means making a conscious choice to learn all you can about money and how wealth is accumulated. Examine the practices, beliefs, and habits of enlightened people who have created and attracted wealth. These are your teachers. Recognize that people who have true wealth do not wear flashy jewelry, drive expensive cars, or wear designer clothes. In fact, the majority of millionaires are budgeters who have created their wealth over the course of time. How visualization can help attract money and success in your life. When you take a trip, do you have a destination in mind? Of course, you do. Few of us get in our car or board a plane without a clear idea of where we are going. Becoming a success in attracting money is no different. Attract money into your life by having your goal in mind. Think big and believe if you can envision it. Then you can achieve it. That's why our previous step was to learn about wealth. To make your vision, you must understand wealth building. A story about visualizing money and success. I will sum it up with a quote I remember from a man I used to work for. His name was John. John was in his 70s. He retired in his 60s, but hated retirement and came back to work. At the time, John and I were in charge of establishing a new business unit for our company. One day John was addressing the employees at a group meeting and said, "Think big, we are only limited by our thoughts." And that quote applies to both you and me. We are only limited by our thoughts. When it comes to thinking big about money, follow John's advice. Think big and establish your vision for future money success. Don't be limited by your thoughts. Now you have a better understanding of your current money state. So, create an abundance mindset about what you have. Don't worry about what you don't have. When I get down about something, I think about this phrase. I had the blues because I had no shoes until, upon the street, I met a man who had no feet. Enough said? Be grateful for what you have. And don't dwell on what you do not possess. An abundance mentality will take you far. Always remember that many people have less than you. 2. Spend less than you earn. One of the most important rules of money is spending less than you earn. If you want to become wealthy, follow this rule. This sounds easy enough, but in practice it can be hard to do. This video looks at the challenges to spending less than you earn and offers some tips to overcome these. First, I want to look at those who spend more than they earn. It stands to reason that if someone is spending more than what they earn, they are either being given money or are borrowing it. In this age of worldwide economic growth and prosperity, it has never been easier to borrow money. Temptation to borrow is everywhere, whether it be for a new TV, a new car, a new house. The problem with personal debt is that it can become a trap. An example of how one can be trapped by debt can be seen with probably its most common form, credit cards. Ideally, people should ensure they pay off their balance in full by the end of the interest-free period to avoid paying interest. Commonly, however, people use their entire credit limit and make only the minimum payment required. This minimum payment is usually just enough to cover the interest charges. Combined with a high interest rate, this makes credit cards a very expensive form of borrowing. Know the difference between your wants and your needs. Let's make this simple. Basic food, shelter, and clothing represent your needs. Everything else is a want. We've convinced ourselves that 2 cars, cable TV, and eating out 3 times a week are essential to our way of living. If not a borderline need, they certainly have become standard for many in America. Then again, so is spending more than we make. See? I told you this wasn't easy. Understand what truly brings meaning to your life. When I was a teenager, my family didn't have much. At one point, our TV broke and my parents couldn't afford to get it fixed or replace it. I literally went through withdrawal symptoms for a week. I didn't know what to do with myself. But after that first week without a TV, I didn't miss it at all. I spent more time reading or outside and went to bed earlier. I ate less junk food too. What I thought was so important in my life turned out not to be that important after all. We went a year without a TV, and why we eventually replaced it, I'll never know. Living below your means is not just about distinguishing between wants and needs. It's also about distinguishing between wants that really bring us fulfillment and those that don't. Learn the difference and you'll spend less money. Positive effects of spending less. 1. You begin eliminating your debts. Spending less than you earn frees up the money you need to make larger payments on your debts. Over time, they begin to disappear, reducing your monthly bills and giving you even more breathing room. 2. You begin to save. First, you build up some cash savings in your savings account, enabling you to roll through emergencies like a car breakdown or a job loss. You'll also have the breathing room to start saving for retirement, paying yourself a great future for your golden years. 3. Your stress level falls. Knowing that you have fewer debts, your emergencies are covered, and your retirement is being planned for reduces your stress level. You sleep better, your overall health improves, and you feel happier about life. 3. Start saving early for maximum wealth. We live in a world of instant gratification, and that inevitably calls for instant expenses. Yet, when the thrill of the purchase is gone, aren't you often left with regret? Also, it might seem like a good idea now to put off saving until a few years later, but the few years later will come up much faster than you'd expect. There is no better time than right now to begin putting aside a little money for your future. And all you need to do is make some small changes in your approach towards life and expenses. Before you know it, you will start to see the savings add up. The first step to start saving money is to figure out how much you spend. Keep track of all your expenses, that means every coffee, household item, and cash tip. Once you have your data, organize the numbers by categories, such as gas, groceries, and mortgage, and total each amount. Use your credit card and bank statements to make sure you're accurate and don't forget any. 2. Budget for savings. Once you have an idea of what you spend in a month, you can begin to organize your recorded expenses into a workable budget. Your budget should outline how your expenses measure up to your income, so you can plan your spending and limit overspending. Be sure to factor in expenses that occur regularly but not every month, such as car maintenance. 3. Set savings goals. One of the best ways to save money is to set a goal. Start by thinking of what you might want to save for. Perhaps you're getting married, planning a vacation, or saving for retirement. Then figure out how much money you'll need and how long it might take you to save it. If you're saving for retirement or your child's education, consider putting that money into an investment account such as an IRA or 529 plan. While investments come with risks and can lose money, they also create the opportunity for growth when the market grows, and could be appropriate if you plan for an event far in advance. 4. Decide on your priorities. After your expenses and income, your goals are likely to have the biggest impact on how you allocate your savings. Be sure to remember long-term goals. It's important that planning for retirement doesn't take a back seat to short-term needs. 5. Make saving automatic. Almost all banks offer automated transfers between your checking and savings accounts. You can choose when, how much, and where to transfer money, or even split your direct deposit so a portion of every paycheck goes directly into your savings account. Splitting your direct deposit and setting up automated transfers are simple ways to save money, since you don't have to think about it. And it generally reduces the temptation to spend the money instead. With mobile and online banking, can easily set up automatic transfers between accounts. 6. Watch your savings grow. Review your budget and check your progress every month. 4. Everyone can become wealthy. There are secrets on how to get rich, and if you take the time to learn them, you too could put yourself on the right path to building wealth. Business owners and entrepreneurs are well positioned to build their wealth and get rich. However, we're not talking about a how to get rich quick scheme. Most self-made millionaires have built their wealth through their business. There are a lot more important things in life than accumulating wealth. Who wants to end up rich, unloved, lonely, and in poor health? However, if you can enjoy a balanced life and at the same time become rich, why not do so? 1. Exploit your skill as a self-employed expert and invest in it. Make it your goal to do one thing better than anyone. Work on it, train it, learn it, practice, evaluate, and refine it. You may find most sports players or entertainers are millionaires. And that is because they are utilizing their skills fully. If there's something you're good at, it is likely you can reap considerable rewards out of it. It is the same concept of being the top of a particular field. When you are the best at something, you find that opportunities come to you. To become an expert of something, it is crucial to never stop improving. Successful people invest time, energy, and money in improving themselves. And it might just be the most rewarding investment you can ever make. To get started, figure out what skill you want to cultivate. Make a list of the world's 10 best people at that one thing. And use this list to define criteria and track your own progress toward becoming the best. If you're a writer, for example, you might consult the New York Times bestseller list and identify the 10 successful authors that you admire the most. Learn more about these writers, what they did to be successful, and read some of their work. Invest the time and energy in improving your own craft by looking at successful past models. 2. Hit $100,000, then invest the rest. Everyone wants to be a millionaire. But a goal like this isn't something you can easily achieve in a short period of time. Aim at saving $100,000 first. The small amounts you save daily is powerful. You might only be able to put away $5 or $10 at a time. But each of these investments are your financial foundation. 3. Develop property. Buying, developing, and selling property has always been a major way for people to accumulate capital. Borrowing could be a key element in this method. Say you borrow $200,000 and put in $50,000 of your own to buy a property for $250,000. Then you develop the property and sell it for $400,000. The property has increased in value by 60%, but your $50,000 has now grown fourfold to $200,000. You have to select the right properties in the right areas and develop them wisely. You are at risk from booms and busts in the property market. However, in the long term, this remains a proven way to accumulate wealth. 4. Build a portfolio of stocks and shares. If you can make steady investments in stocks over a long period, choose wisely and reinvest the dividends, then you can build a large store of wealth. Of course, stocks can go either way, and many small investors lose heart when their portfolio plunges. But over the long term, equities are as good an investment as property and much more liquid. 5. Become a money magnet. Achieving financial freedom and abundance is something that many of us desire. So what if I told you this was possible through the law of attraction? All you have to do is address any blocks you have to becoming a money magnet, and use the powers of the universe to achieve it. The law of attraction is one of the rules of the universe that states that the energy we put out into the universe is what we get back. 1. Evaluate your beliefs about money. Do you have deep-rooted negative beliefs about money that you might not have noticed? This is one of the biggest blocks to manifesting a life of abundance. But it can definitely be changed, so don't give up. Reframing your beliefs. If you're watching this video, then I'm almost certain you believe that everything in life involves an exchange of energy. Right? Well, money is no different. My favorite way to reframe money in a positive light is to view it as an energy exchange. The numbers we see in our bank accounts are simply a physical representation of this energy. The reality is, we put in the work to receive this energy back. We then have the reward of directing this energy wherever we want to invest it, whether that be in something physical, like a house, or an experience like travel. When you think about it this way, is there really anything wrong with this energy exchange? We put in the work and dedication, and we are rewarded. That seems like a fair deal to me. 2. Use money affirmations to change your money magnet mindset. One of my favorite tools to work with the law of attraction is affirmations. Affirmations have the power to not only rewire your neural pathways, but to also send out those good vibes to the universe that are vital for manifestation. Here are some of my favorite money magnet mantras to manifest money fast. I am a money magnet. I am financially abundant. I release all resistance to attracting money. Money flows freely to me. 3. Practice gratitude for money. You'll see that one of the affirmations I shared above includes gratitude. And that's because gratitude is a huge part of manifesting with the law of attraction. To get into a place of receiving, we have to show the universe that we're grateful for what we've already got. In turn, the universe will reward us with more of that thing. One thing we certainly do not want to do is approach attracting money from a place of lack. If we have the mindset that we don't have enough, then the reality is, we are never going to have enough. Instead, reframe it. Try, I am grateful for the money that I already have, and I am open to receiving more. Stop obsessing over the money you want, and start focusing on your gratitude for what you already have. You'll be surprised how much this shifts your energy, which in turn allows you to become a money magnet. 4. Visualize yourself being financially abundant. Visualization is such a powerful method to manifest your desires. Why? Because when we visualize the life we want to live, as if we are living it, our brains can't actually tell the difference. This means if we visualize strongly enough, and believe it to be true, we send out the energy that this is our reality. If we want to become financially abundant, we have to visualize ourselves as financially abundant. Use the powers of your imagination to place yourself in the reality you want to live in. 6. Rich families do this. As a parent, you want the best for your children. This doesn't necessarily mean you want them to have the best clothes, the latest toys, or coolest gadgets. And you want to lay a foundation that they can build upon to do well in life. That lesson is about money. Without a working knowledge of money, it is extraordinarily difficult to do well in life. Money is central to transacting life, day in and day out. Where we live, what we eat, the clothes we wear, the car we drive, healthcare, education, child rearing, gift giving, you name it, money is involved. 1. They talk about money. Rich people give money attention. They talk about money, and they are not ashamed of it. It's a welcome and natural aspect of their lives. Something to be addressed. They talk with their kids about how much things cost, and they compare it with the cost of other things. They tell them what they are saving for and how much. They look forward to buying it. They tell them about earning money and investing money. It's not a taboo. 2. They teach them to manage money. They don't stop at talking about money. They teach them how to manage it. They give them pocket money that they have the full control over. Give your children pocket money from the time they are big enough to count to 10. When you let go, they learn valuable lessons that only experience can teach them. They learn how to direct and manage their money. It's much better to be a little generous with the pocket money and stop giving them random things that they ask for. Look at your monthly account statement. How much do you actually spend on miscellaneous things like snacks and toys for your kids? Give them the ability to control that money instead. The lessons they learn will be very valuable, much more valuable than the pocket money itself. 3. They teach them abundance. You must stop saying scary things like "we can't afford that," or "you are ruining me." Now, you are probably thinking that it's easy for rich people to avoid saying they can't afford something, since they have a lot of money. But honestly, admit it, you're saying this to your kids even when it's not true, right? It's just something to say, like an automatic response. Teach them that money is not a limited resource. There is plenty of money, you just need to figure out how to make more of it. If you think of money as limited, you will never really feel comfortable earning lots of it, because you will feel that you are taking something from someone else. What you get is something someone else is not getting. But it isn't like that. When money flows fast, there is more of it. It's not like a cake that can only be eaten once. Money is unlimited. Teach your kids that there is plenty for all of us. Tell them that. 4. They teach them to make money. Let them make money. Let them experiment and be creative with it. Let them sell used toys on a flea market. Let them collect bottles. Let them get a bit of interest on the money they've saved. Let them get the dividends on stocks that have been paid out, and give it to them in cash. Earning money will give them valuable lessons for life. If they ever need money in the future, their brain will be conditioned to think of solutions, instead of being conditioned to ask their parents for money to fix the problem. 7. Never become poor again. Many people find themselves in vulnerable positions after being rich for a while. But it doesn't have to be that way. You can still be rich after so many years without becoming impoverished. Some people get lost in their wealth, and they end up getting blinded by it. And of course, they eventually end up regretting their decisions. For people who want to get rid of poverty, there are specific steps they should follow. Getting rid of poverty is not as easy as wealthy people would make it look. Take a look at the steps that most rich people out there are undoubtedly loyal to. 1. Decide not to be poor again. This decision might seem like an easy task that you can tell yourself, but it is not. Making up your mind never to be poor again goes deeper than you can imagine. Before you spend any money, you have to, first of all, think to yourself, if I spend this money doing this, will it benefit me financially? If not, you shouldn't think about spending the money. As the saying goes, suffer now and enjoy later. Next, you have to think of the future instead of spending it all at a go, then being left with nothing. 2. Pay yourself first. Poor people pay their bills first, rich people pay themselves first. The thing about the poor people's process is that they pay the bills and never get to paying themselves anything. You're not meant to just pay bills until you die, right? This is where having a business really becomes valuable. With businesses being taxed differently, you can afford to pay yourself first and have additional capital. You become a deductible expense and the business takes care of the bills for you. This money should immediately go towards investments of any sort. We strongly recommend you automate the process so that money leaves your personal account automatically. This is what they mean when you hear others say have your wealth creation on autopilot. The thing is, you can never do this unless you pay yourself first. Bills will eat away at your money and you'll never have anything left in your account. 3. Make a list of what you spend your money on and what brings you money. Take a look at that list and make sure that whatever you spend your money on is lower than what brings you income, even if it means cutting down some of your expenses. Support the asset that brings you money. Once you know you have money coming in from your work and your income generating asset, take a part of your work money and invest it in your income generating asset. Some people might want to go ahead to start up another business. But it is too early to do that until your income-generating investment becomes stable. 4. Build an asset. Earning money while you sleep, a different kind of happiness. Invest into something or start up something that wouldn't involve trading your time for it. Such as real estate, book publishing, e-commerce, running blogs and YouTube channel, or creating software application, or any intellectual property that brings you money beyond your lifetime, etc. 5. Save money by investing in assets. Saving money is not as you think. Save money not for bad days, but opportunities. What exactly does this mean? It means that you should keep aside a particular sum of money that will be used whenever an opportunity comes up. The kind of opportunity that is worth your money, of course. This money saved should be in stocks and trusted brokers. This is because money is supposed to be multiplied, not the other way round. 8. Do this before investing money. If you do not find a way to make money while you sleep, you will work until you die. Warren Buffett. Now, the easiest way to make your money while you sleep is by investing. However, if the investments are not done in a planned manner with a proper objective in mind, it can even jeopardize your financial future. So, you're thinking to start investing. But before you enter, are you prepared? Do you actually meet all the requirements that will make your investment journey smoother? In this video, we'll discuss such things that you should do before you start investing. 1. Build an emergency fund. As the name suggests, an emergency fund is a money that you put aside for emergencies. It is the money that you can reach out to during your hour of need and pay for those unforeseen and unexpected expenses, such as loss of a primary job, medical emergency, personal emergencies, or even a car breakdown. As a thumb rule, before you start making investments for your long-term goals, first you should build an emergency fund that should be greater than at least 12 months your annual expenses. Keep this money aside in a separate account. 2. Pay down high-interest debt. First of all, please note that not all loans or debts are bad. Here, we are talking about high-interest debts. For example, if you have taken a personal loan, its interest rate may vary from 13 to 18%. Similarly, a credit card company may charge you even higher interest on the outstanding amounts. It doesn't make much sense to invest if the profits that you make on your investments are lesser than the interests that you pay on your debts. For example, if your returns are 12% and you're paying 14% as interest on your previous debt, then overall you're at a loss. Here, instead of investing, it will be better to use that money to pay back and become debt-free. Before you start investing, try to minimize or eliminate debt, especially high-interest debts and your credit card debt. These interests can kill your investment profits. 3. Take a health insurance. When people are in the best of their physical health, an obvious question among them is, why should they invest in health insurance? Paying a premium plan for ensuring health may seem an unnecessary expenditure. However, accidents or health issues may come up anytime unexpectedly, which can put a lot of financial and mental pressure. Further, it is a fact that, as you grow older, health issues come along with it. And hence, it is highly necessary to incorporate healthcare planning within the budget of your family's financial planning. Before starting your investment journey, make sure that you understand what is meant by stocks, bonds, mutual funds, diversification, liquidity, volatility, and other investing basics. Here, you do not need to become a finance geek or an accountant. However, you should have good enough knowledge of the industry to make intelligent decisions. 9. Make money from loans. You may have heard of debt being categorized as two types: good debt and bad debt. Good debt allows you to manage your finances more effectively, to leverage your wealth, to buy things you need, and to handle unforeseen emergencies. Examples of good debt are taking out a mortgage, buying things that save you time and money, buying essential items, investing in yourself by borrowing for more education or to consolidate debt. Each may put you in a hole initially, but you'll be better off in the long run for having borrowed the money. Bad debt refers to things like credit cards or other consumer debt that do little to improve your financial outcome. These are oversimplifications. The distinctions between good and bad debt are a lot more nuanced. Generate money through loans. 1. Small business loan. If you want to get really rich, your chances are much better if you start your own company and work for yourself. Entrepreneurism is all the rage, and ideas for proven small businesses abound. But have a plan, and maybe some personal backers. Small business loans are tougher to get because they are riskier to the lender. Almost 1/3 of small businesses fail to survive their first 2 years, according to the Small Business Administration. But if you have enough ambition, savvy, and luck, borrowing money to start your own business could be the best investment you'll ever make. 2. Taking out a mortgage. The king of all debt is a mortgage. For one thing, you have to live somewhere. For another, you might as well live somewhere that increases in value almost every year. Yes, the real estate bubble burst in 2008 and temporarily made us reconsider home ownership as the storehouse of American wealth. But look what's happened since the bleak bottom of the Great Recession in 2010. Houses are back, big time, prices rising 27.25%. In 2020 alone, in the midst of our national coronavirus lockdown, home prices surged 10.8%. According to the Federal Housing Finance Agency, the strength has been steady, having shaken off the worst effects of reckless, predatory subprime lending. FHFA reports house prices have risen every quarter since September 2011. What's all this mean in real money? If you buy a home for $235,000 and it appreciates 3% a year, it will be worth $485,000, more than twice what you bought it for when your 30-year mortgage is paid off. If it appreciates 4% a year, that initial $235,000 investment will be worth $649,000, or almost 3 times the purchase price. Now that's quality debt. 3. Getting a home equity loan. Home equity loans and home equity lines of credit are essentially cousins of a mortgage. Borrowers secure a loan at a comparatively low interest rate using the equity, the value above the mortgage balance of their house, as collateral. A lot of consumers take home equity-based loans to pay off higher interest debts, such as credit cards. Some use it to make home improvements like solar panels. That could save money on utility bills and increase the value of their home. The gambit isn't entirely stress-free. Failure to keep up the payments can result losing your house to foreclosure. 10. Make money work for you. Money is a tool that can help you to achieve your goals. It can provide comfort and stability for your family, make it easier to plan for the future, and allow you to save towards important milestones. But to achieve these things, you need to know how to make your money work for you. What does it mean to make your money work for you? Making your money work for you means taking control of your finances, then using that control to continuously improve your financial stability and security. You may eventually be able to gain financial independence or build wealth through investing. But neither of those things can happen without first understanding where your money is going and learning better ways to use it. Investing money is akin to making it. It is a long-term strategy for building actual tangible wealth that can be utilized as income later on. There are several options to grow money through investments. 1. Stocks. The stock market can be a daunting place for novice investors. But with a little amount of effort, the risks are worth the reward. Stocks essentially represent legal ownership in a company. When you invest in a stock, you automatically become a part owner of the company. Investing in stocks can be an efficient way to build wealth gradually over the years. One of the easier ways to make a foray into the stock market is by investing in mutual funds or index funds. These investments are like a group of diverse stocks and other holdings that appreciate over time. Mutual funds are the better options for first-time investors to generate income. as they require very little effort and planning to get started. The most important thing to remember while investing in stocks is that it is a long-term process. Don't be jolted by short-term volatile events like this pandemic and withdraw your money. Because markets are resilient and your patience will pay off in the long run. 2. Real estate. This is a popular investment class. A lot of people prefer it because, unlike stocks and bonds, it is a tangible asset. Real estate gives people the sense of ownership, and its value appreciates over time. However, the only major hurdle with real estate investments is the cost of maintaining it. 3. Develop sources of passive income. With the advent of social media, there are more ways than one to achieve financial stability and security. Online content creation, voiceover work, freelance writing gigs, part-time marketing are just some of the options that people can explore to generate some additional income. This money can be a surplus to your staple monthly income and can thus be solely directed towards savings and investments. 4. Claim your tax credits. If you are charged more tax than you are actually liable to pay, then the excess amount is made available as a tax credit. This credit can later on be adjusted against any future tax liabilities. Example: the credit is entirely deductible from the amount of tax you have to pay, and this is regardless of the tax bracket you fall into. So make sure to claim your tax credits. 5. Credit card rewards. Although this might sound slightly trivial, earning cash just by spending the money you normally would is always a bonus. Rewards cards work best when you pay off your balance each month. But remember to avoid making extra purchases just to get rewards points, because that defeats the purpose of curtailing unnecessary spending. 11. Never do this mistake in investing money. Investing in the stock market can be a tricky game, and if you're not careful, you may make some grave investment mistakes that could cost you a lot of money. First-time investors are habitually too eager to jump right into the investment game, and quite often do not commit to learning from the mistakes of others. Fortunately, by taking the time to get to know the common investment mistakes most investors and traders are prone to, you can ensure that you avoid making those costly errors. 1. Not understanding the investment. One of the world's most successful investors, Warren Buffett, cautions against investing in companies whose business models you don't understand. The best way to avoid this is to build a diversified portfolio of exchange-traded funds, ETFs, or mutual funds. If you do invest in individual stocks, make sure you thoroughly understand each company those stocks represent before you invest. 2. Lack of planning. Seasoned investors tend to have a plan based on facts and figures. First-time investors, however, often give into the guessing game and blindly invest in stocks that appear to be performing well. The downside to not having a proper plan in place is that you have no end goal. And as a result, your investment pattern can be quite erratic. This, in turn, could turn you into a reckless investor, resulting in greater losses if you're not careful. How to avoid this mistake? The simplest way to keep yourself from making this investment mistake is to take some time to chart out a financial plan before you begin investing. Identify your goals and pick a strategy. Look into the financial data of companies you plan to invest in, and make informed decisions as opposed to blind guesses. 3. Personal bias. Beginners trading in equity are prone to allowing personal bias to drive their investment decisions. For instance, many first-time investors tend to either only buy companies they know or companies they like. This is clearly not the best way to go about investing or trading in equity, because companies you know or like may not always be the ideal investment options for your risk profile or your financial goals. How to avoid this mistake? One way to avoid allowing personal bias to rule your investment decisions is to focus on research and obtain financial information about the companies that you're interested in. Research-based investing can help you overcome any bias you may possess, so you can make unprejudiced and informed trade decisions. 4. Refusal to cap losses. Beginners also tend to hold stocks and financial assets even when they're not performing well. If a stock's value is plummeting, many first-time investors and amateur traders are prone to refraining from selling the asset in the hope that its value would shoot back up in due time. In most cases, this may never happen, leaving investors with significant losses that could erode their capital greatly. How to avoid this mistake? You could set a limit for losses, beyond which you will have to sell off a loss-making stock, thus limiting your capital erosion. Many trading platforms come with a specific stop-loss feature exclusively for this purpose, so you can set a specified price at which to sell your loss-making stock. 5. Short-term focus. The idea that investing in financial assets or trading in equity can make you get rich quickly can often limit your focus to the near future alone. This stops you from thinking about the long-term effect of your investment decisions, and that could be extremely damaging to your financial future. 12. How to choose your investment. Before start investing any asset class, you should understand some of basic things like duration of investment, risks and benefits of particular asset, diversification of assets, benefits of diversification. All those are essentials to know. Here we learn some basics of how to choose your investment. 1. Know your timeline. You need to commit to a period of time during which you will leave those investments untouched. A reasonable rate of return can be expected only with a long-term horizon. When investments have a long time to appreciate, they're more likely to weather the inevitable ups and downs of the equities market. It may be possible to generate a return in the short term, but it's not probable. As legendary investor Warren Buffett says, "You can't produce a baby in 1 month by getting 9 women pregnant." 2. The magic of compounding. Another important reason to leave your investments untouched for several years is to take advantage of compounding. When people cite the snowball effect, they're talking about the power of compounding. When you start earning money on the money your investments have already earned, you're experiencing compound growth. This is why people who start the investing game earlier in life can vastly outperform late starters. They get the benefit of compounding growth over a longer period of time. 3. Choose the right asset classes. Asset allocation means dividing your investment into several types of investments, each representing a percentage of the whole. For example, you might put half your money in stocks and the other half in bonds. If you wanted a more diverse portfolio, you might expand beyond those two classes and include real estate investment trusts, REITs, commodities, or international stocks. To know the right allocation strategy for you, you need to understand your tolerance for risk. If temporary losses keep you awake at night, concentrate on lower risk options like bonds. If you can weather setbacks in the pursuit of aggressive long-term growth, go for stocks. Neither is an all-or-nothing decision. Even the most cautious investor should mix in a few blue-chip stocks or a stock index fund, knowing that those safe bonds will offset any losses. And even the most fearless investor should add some bonds to cushion a precipitous drop. 4. The rewards of diversification. Choosing among various asset classes doesn't just manage risk. Greater rewards come from diversification. Nobel Prize-winning economist Harry Markowitz referred to this reward as the only free lunch in finance. You will earn more if you diversify your portfolio. Here's an example of what Markowitz meant. An investment of $100 in the S&P 500 in 1970 would have grown to $7,771 by the close of 2013. Investing the same amount over the same period in commodities, such as the benchmark S&P GSCI index, would have made your money grow to $4,829. Now, imagine you adopt both strategies. If you had invested $50 in the S&P 500 and the other $50 in the S&P GSCI, your total investment would have grown to $9,457 over the same period. This means your return would have surpassed 13. Time is more valuable than money. Most people look at their bank accounts with great attention and assess how much money they have to spend, to invest, and to give away. But they don't look at their time the same way. and end up wasting this incredibly valuable resource. In fact, time is much more valuable than money, because you can use your time to make money. But you can't use money to purchase more time. How to use our time more effectively to make more money? 1. No opportunity cost of time. You can pretty much do all the work your domestic help does, but you nonetheless pay her to perform those chores so that you can use your time elsewhere, right? It is better to get help when we don't have the required time or expertise, even though it comes at a cost, because the time thus saved can be used productively. For example, a doctor could earn much more from devoting the same time to his practice and tending to patients, instead of trying to manage his stock portfolio himself. 2. Respect others' time. This is crucial for healthy relationships and to maintain professional connections. You may end up suffering monetary loss if you don't practice this ethic. For example, you may lose business if you keep your client waiting. Respecting others' time schedules. Timelines is a must if you want others to respect your time too. 3. Audit your time for 7 days straight. Spend 7 days straight assessing how you spend the time you do have right now. What are you doing? Record it in a journal or on your phone. Split this up into blocks of 30 minutes or an hour. What did you get done? Was it time wasted? Was it well spent? If you use the quadrant system, circle or log the quadrant that the activity was associated with. At the end of the 7 days, tally up all the numbers. Where did you spend the most time? Which quadrants? The results might shock you. 4. Follow the 80-20 rule. Another great time management tip is to use the 80-20 rule, also known as the Pareto principle. This rule states that 80% of the efforts comes from 20% of the results. In sales, it also means that 80% of the sales come from 20% of the customers. The trick? Identify the 20% of the efforts that are producing 80% of the results and scale that out. You can do this with meticulous tracking and analysis. 5. Eliminate bad habits. One of the biggest time wasters we have are our bad habits. Whether it's Netflix binge watching, excessively surfing social media, playing games, going out frequently to drink with friends, or so on. Those bad habits take away the precious little time that we do have. Use your time wisely by eliminating your bad habits if you're serious about achieving big goals in life. 6. Make to-do lists in the evening for the next day. Every single evening before bed, make a list for the next day. Look at your goals and see what you can do to help move you closer. This doesn't happen overnight. It takes time. But by making to-do lists, you're effectively setting goals for the day. Daily goals are easier to achieve while helping to move us towards the longer and bigger goals. But that happens by creating to-do lists. 14. Never go into debt for depreciating assets. Finally, one of the key to becoming rich is to avoid making bankers and credit card lenders rich. Some purchases, like buying a home or paying for a college education, are difficult to make if you don't go into debt. But both student loans and mortgage debts are generally classified as good debt. Because buying a home and getting an education can ultimately increase your net worth. Rising property values and enhanced career opportunities offset the cost of debt. Other assets, however, don't go up in value. So if you're borrowing to buy them, you take a double hit. Interest plus depreciation. A car is one of the worst depreciating assets you can go into debt for, as it loses value very quickly and interest can be very costly. For any depreciating asset, including your vehicle, make it your goal to pay cash. If you cannot afford the item, delay the purchase or look for a cheaper alternative. When you're spending less money on interest and aren't seeing your net worth decline each month because most of your assets are depreciating, it is a lot easier to accomplish the other key goals, like living below your means and saving for a rainy day. Things to avoid to become rich. 1. Luxury brands. Millionaires can afford the latest fashions from the top designers, but that doesn't mean they're spending their hard-earned money on high-end apparel. In fact, the founder of IKEA, Ingvar Kamprad, told Newsweek that he doesn't wear anything that is not from a flea market to set a good example. And Bill Gates told Time that he still wears a $10 watch despite being able to afford a closet full of Rolexes. These are the money tricks that can save you $1,000 a month. 2. Buying instead of renting. Some rich folks are going so far as to not even deal with the hassle of buying a home. Many are opting to rent, according to Extras Mansions and Millionaires host Michael Corbett. Renting is more popular than ever, even among the wealthy. While it once made sense for people who could afford it to buy a home and flip it after 2 years, and the market has improved moderately this year, we're hardly in a boom. 3. Multiple credit cards. It's understandable that a wealthy person might not want to walk around with a ton of cash in their pocket. But don't think for a second that their wallet is filled with a credit card from every bank. Tom Corley, author of the best-selling book Rich Habits: The Daily Habits of Successful People, told U.S. News and World Report. Only 8% of rich people use more than one card. Meanwhile, 77% of poor people have multiple credit cards. With more cards, there are more fees to keep track of, more finance charges to accrue, and generally more opportunity to buy things you don't need. Here's when to never use a credit card for payment. 4. Late fees. No one likes to pay pesky late fees when they miss a bill or payment, especially rich people. That's why they're diligent about setting up autopay on all their accounts, from mortgages and car payments to credit cards. And insurance, according to David Bach, author of Smart Women Finish Rich. As he told LearnVest, late fees can add up to a fortune. Don't miss these sneaky ways to lower your household bills. 5. Things that don't last. Even if rich people have the money to replace an item that wears out or breaks, they still don't want to waste their money that way. Wealthy people understand that the cheapest route isn't always the most valuable. They can take the long view and consider how what they pay today compares with the worth over time. 15. Know how wealthy people think. Rich people don't think like average people. That's the world we live in. Being able to maintain a massive wealth over a long period of time is not something easy if you don't have the right mentality. Self-made millionaire Steve Siebold spent 26 years interviewing some of the wealthiest people in the world before condensing his findings in his book, How Rich People Think. He found that the secret to getting rich is not in the mechanics of money, but in the level of thinking that generates it. In addition to having larger bank account balances than most, rich people have different beliefs, philosophies, and strategies. How would you explain that a large number of lottery winners who go broke after a few years? They don't have the rich people mentality. When you look at the way rich people think, you will notice some intriguing similarities. They think about themselves first. 1. Rich people believe money is earned through thinking, while the average person believes money is earned through time and labor. The middle class think about money in linear terms, Siebold explains, and believe the only way to earn more money is to work more hours. The wealthy know big money requires thinking about it in non-linear terms. The rich know that creative thinking is the highest paid skill in the world. Training your mind to find solutions to difficult problems is the real secret to making money. 2. They prefer specific knowledge over formal education. Since they are action-oriented, they prefer an education that serves a concrete goal. Education is important, but becoming excellent in a specific area is more important. Rich people become extremely rich by being excellent at doing something, or at doing something nobody has dared to do. College dropouts following their startup dreams to become billionaires are a long-lasting cliché. But the truth is that developing specific expertise early on will give them an edge. 3. They surround themselves with like-minded people. Having the lifestyle of rich people is very peculiar. They don't share the same interests as other people. And there are not many people with whom you can share your concerns about having to pay millions in income taxes. They will flock together in similar gatherings and enjoy being together anywhere in the world. 4. They raise their children to be rich. Their children will handle a huge fortune as well. It is quite a sad prospect to think that your children will dilapidate the money you or your parents made with hard work. They will try to teach them the value of money, so that they learn to take nothing for granted. 5. Average people think selfishness is a vice. Rich people think selfishness is a virtue. The rich go out there and try to make themselves happy. They don't try to pretend to save the world. The problem is that middle-class people see that as a negative, and it's keeping them poor. If you're not taking care of you, you're not in a position to help anyone else. You can't give what you don't have. 6. Rich people believe the wealthy are more savvy, while the average person believes the wealthy are smarter. If the key to building wealth was excellent grades in school, every summa cum laude college graduate would be rich, Siebold argues. Amassing money has more to do with street smart savvy than your ability to memorize information and excel on exams. How do you become more savvy? Get inside the heads of people who are already rich, Siebold advises, and find out what they think and believe about money. 7. Rich people believe starting a business is the fastest way to make money, while the average person believes starting a business is risky. The truth is, having a job is no safer than owning a business. As counterintuitive as this may seem, people who work for themselves have the power to proactively seek out business and increase revenues at will. Of course, there are risks involved in starting a business. But wealthy people know the greatest risk is not betting on themselves. While rich people launch businesses and profit from them, average people settle for the steady paycheck and therefore miss out on the chance to generate a fortune. The masses almost guarantee themselves a life of financial mediocrity by staying in a job with a modest salary and yearly pay raises. 8. Rich people believe being wealthy is a right, while the average person believes being wealthy is a privilege. World-class thinkers know in a capitalist country they have the right to be rich if they're willing to create massive value for others. The masses think getting rich is reserved for a lucky few. This distinction in thinking leads the middle class to the lottery and the world class to work. The wealthy believe if they make life better or easier for others, it's their right to be rich. 9. Rich people believe building wealth takes a team, while the average person believes building wealth is an individual effort. The world class knows it takes a team to build wealth, and they focus much of their effort on finding the right people to leverage their actions and ideas. The greatest fortunes are built through the collective mental and physical contributions of a world-class team. He contends that who you surround yourself with has more of an effect on your net worth than you may think. Warren Buffett and Bill Gates prepare to do the newspaper toss at the Berkshire Hathaway annual shareholders meeting in Omaha, Nebraska. 10. Rich people believe in working for fulfillment, while the average person believes in working for money. The rich have always known working for the sole purpose of making money is the worst strategy for building wealth. Don't look for jobs with the greatest salary potential. Rather, focus on work that has the most fulfillment potential. Once you find it, invest so much heart and soul into your work that you become one of the most competent people in your field. You'll be rewarded with uncommon wealth. 11. Average people focus on saving. Rich people focus on earning. The masses are so focused on clipping coupons and living frugally they miss major opportunities. Even in the midst of a cash flow crisis, the rich reject the nickel and dime thinking of the masses. They are the masters of focusing their mental energy where it belongs, on the big money. Average people play it safe with money. Rich people know when to take risks. Leverage is the watchword of the rich. Every investor loses money on occasion, but the world class knows no matter what happens, they will always be able to earn more. Average people love to be comfortable. Rich people find comfort in uncertainty. For the most part, it takes guts to take the risks necessary to make it as a millionaire. A challenge most middle-class thinkers aren't comfortable living with. Physical, psychological, and emotional comfort is the primary goal of the middle-class mindset. 12. Average people believe you need money to make money. Rich people use other people's money. Linear thought might tell people to make money in order to earn more. But Siebold says the rich aren't afraid to fund their future from other people's pockets. Rich people know not being solvent enough to personally afford something is not relevant. The real question is this worth buying, investing in, or pursuing? Average people believe the markets are driven by logic and strategy. Rich people know they're driven by emotion and greed. Investing successfully in the stock market isn't just about a fancy math formula. The rich know that the primary emotions that drive financial markets are fear and greed. And they factor this into all trades and trends they observe. If you like this video, please subscribe to our channel and share with your friends and family. If you want to see this video as individual parts, click this link to enjoy watching. If you have any questions, any thoughts, any comments, comment on the bottom.